Will robo-advisors replace financial advisors? Money has always been a deeply personal subject. From saving for your first car to planning retirement, the journey is filled with emotions, uncertainties, and dreams. And for decades, people have turned to human financial advisors to help guide them through this complex landscape. But now, a quiet revolution is underway. It doesn't wear a suit, it doesn't take lunch breaks, and it doesn't ask for a commission. It's a robot, or more accurately, a robo-advisor. These digital platforms have been gaining traction for more than a decade, promising low-cost, automated investment management accessible to the masses. But with AI evolving at lightning speed, a question now looms over the financial world. Will robo-advisors eventually replace human financial advisors? Or is there more to money management than just algorithms and code? Let's dive deep into what robo-advisors are, how they work, their advantages and limitations, and whether they truly pose a threat to traditional financial professionals or whether the future lies in a partnership between man and machine. What exactly are robo-advisors? Robo-advisors are digital platforms that use algorithms and software to provide financial planning services with minimal human intervention. Most of them start by collecting information from the client through an online survey. Things like income, financial goals, risk tolerance, and time horizon. Once the platform has this data, it builds a diversified investment portfolio, typically composed of low-cost exchange-traded funds (ETFs), and automatically manages it, rebalancing portfolios, reinvesting dividends, harvesting tax losses. Robo-advisors can handle it all. The idea isn't new. The first modern robo-advisors appeared around 2008. Companies like Betterment and Wealthfront were among the pioneers. Since then, big players like Vanguard, Schwab, and Fidelity have launched their own versions. What was once considered a novelty is now a $1.4 trillion industry and growing fast. The benefits of robo-advisors. So, why are these digital advisors becoming so popular? 1. Lower costs. Traditional financial advisors often charge between 1% to 2% of assets under management annually. Robo-advisors, many charge just 0.5% to 0.5%. Some platforms even offer free services for certain accounts. 2. Accessibility. You no longer need to be wealthy to get professional investment advice. Many robo-advisors have no minimum balance requirements, making them ideal for new investors, students, or those just starting their financial journey. 3. Convenience. Want to open an investment account at midnight? No problem, need to rebalance your portfolio. The algorithm already did it. Robo-advisors run 24/7, offering hands-off investing with just a few clicks. 4. Emotion-free decision-making. Unlike humans, algorithms don't panic during market crashes. They don't get greedy during booms, they follow the data, not the drama. Where robo-advisors fall short. But while robo-advisors offer impressive features, they're not without flaws. There are several areas where human advisors still maintain an edge. 1. Lack of human touch. A machine can calculate risk tolerance, but it can't talk you down from panic during a market crash. It can't empathize with your fear of outliving your retirement savings or understand that you want to help your grandchildren with college. Financial planning isn't just numbers, it's emotions, life changes, and dreams. Sometimes, you need a person, not an app. 2. Complex life situations. Robo-advisors work best for straightforward scenarios. But what about planning for a blended family, managing a family business, or navigating inheritance issues? Human advisors can think through these complexities in a way that robots can't. 3. Tax and estate planning nuances. While some robo-advisors offer tax loss harvesting, estate planning is far more complicated. Coordinating trusts, understanding multi-state laws, or structuring tax-efficient withdrawals, these are areas where experienced advisors shine. 4. Behavioral coaching. Arguably one of the most underrated services human advisors provide is behavioral coaching. When markets tank, many investors are tempted to sell everything. A good advisor knows when to hold your hand or talk you out of poor decisions. That guidance can have a massive impact on long-term returns. 5. One size doesn't fit all. Despite personalization algorithms, robo-advisors often use model portfolios based on a handful of questions. Human advisors dig deeper. They ask follow-up questions, uncover hidden priorities, and adapt plans on the fly. the human versus machine debate. This isn't just about technology replacing people, it's about how each adds value. Think about pilots and autopilot systems. Planes have had autopilot for decades, yet no one argues to get rid of human pilots. Autopilot handles routine tasks. Pilots make decisions in emergencies, interpret unusual data, and provide judgment when things go sideways. Robo-advisors are financial autopilots. They're fantastic at optimizing portfolios and minimizing costs. But when life throws a curveball, many people still want a trusted advisor in the cockpit. Hybrid models, the best of both worlds. Recognizing the strengths and weaknesses of each, many companies now offer hybrid models. These platforms combine algorithmic management with access to real financial advisors either via chat, video call, or email. Vanguard's personal advisor services, for instance, gives users access to a human advisor while using robo-technology in the background. Betterment Premium offers unlimited access to CFP professionals for a higher fee. This blended approach offers the efficiency of automation with the empathy and wisdom of human advisors. It's not man versus machine, it's man with machine.